good afternoon, everyone. I wanted to thank you for joining. We've already got a number of folks who have who've begun, and I'm sure more will join with us. But today we're continuing our presentation of our JRBT tax talks. We have been, as most of you know, we've been over the last few weeks beginning a video series to kind of help clients and taxpayers understand, especially lately, has been all the provisions related to the CARES Act, all the provisions related to the different ways that we can help taxpayers and how Congress has attempted to help taxpayers make it through this pandemic time. And today we're going to continue that. As I mentioned, we've had a number of videos already on the PPP loan application, the loan forgiveness, and other things. I would recommend that you try and take a look at if you haven't seen all those, go to our website, www.jrbt.com. to see all those videos that we've done and be able to hopefully get yourself and your business as much information as you can to weather through this storm. But today, we're going to have a little bit different focus. First of all, I want to introduce myself. I'm Bob Woodard. I'm a shareholder here at JRBT in the tax department. And, really, we at JRBT are so excited to be able to bring this information to our clients and our friends about the tax laws. And so now, Vicki, I'll let you introduce yourself.
Hi, I'm Vicki Stalnaker. I'm Director of Operations for Payroll Systems, a division of JRBT, which is our payroll service bureau.
All right. Like I said, today we're going to focus really on, we've been focusing on the tax aspects of it, but today we're going to focus a lot on the payroll tax credits and the payroll tax changes. They are significant. To say the least, right, Vicki? So we'll have we can't get through all of it, but we're going to try and get through some of the highlights and help you guys understand what all the options are out there for your business. But again, we definitely want you to look at all the other videos about the other PPP loan, and in fact, Vicki and Angie Reagan did a video a couple of weeks ago about the FFCRA. That's for the folks, the loan for, the wages you're paying to folks who are directly related to COVID, you may get some credits. I'd highly recommend that if you're involved in payroll, make sure you've seen that video because it gives a lot of great information on the FFCRA. So we're not going to touch a lot on that today, but Vicki, I'm going to let you kind of take over the disclaimer.
Okay. So once again, our webinar is for informational purposes only. So you definitely need to consult with your tax advisor, your HR professional as well, dealing with your employees, and also your legal counsel to see how these various acts apply to you as the employer and also to your employees to make sure you're in line with them.
Excellent. Well, and then as Vicki just said, every single one of you has a different situation. We can't, no matter how long this video would be or how many videos we do, we cannot get to your situation exactly. And so it's critical that you have a conversation with your tax advisor, with Vicki and her folks and your payroll and your attorney to make sure you're covered on all these different things. We want to get you the most relief we can, but each one of you has a different situation. So, and with that, I kind of want to just jump into it. As I've said in the intro here, we've had a lot of information on the PPP loans. We've got a lot of information on the CARES Act and all those different things. But we really haven't talked a lot about all the options of a payroll yet in these videos, and that's what we want to kind of do. So Vicki, kind of give us a couple other relief options that are available besides that PPP loan everybody knows about. They've heard on the news, they've heard updates, but there's a lot of other great things that they could do.
Yes. The CARES Act actually had two different payroll provisions in it to assist with employers. So we're going to start with kind of the smaller provision of the CARES Act, which is the Section 2302, and it deals with the employer's deferral of Social Security tax. So it's just the employer side of Social Security tax, but you're able to defer that amount, which is 6.2% of your wages. It's subject to the Social Security wage limit of each year, but you're able to push paying those payroll taxes to a later date. So it especially helps with cash flow right now. If operations are slower, cash isn't coming in as much, it helps not having that cash outflow right now, in hopes that eventually in the future, operations come back to normal or are hopefully better than normal in the future to be able to pay that tax at that time. So it just gives a little more help to the employers right now.
Excellent. Yeah, and of course that is a deferral. It's not any kind of credit. It's not any kind of I was saying just a deferral. We'll talk a little bit more about that as we go along. But you know, and so what dates can we defer those taxes? What and when are those going to be due? I mean, that's the big question. Do I really want to defer those, and how long do I get to defer them?
Okay. So with the deferral, it's for wages paid between March 27th and December 31st. So you can defer Social Security tax starting right now. If you haven't been deferring, you can start deferring with your next paycheck that you're paying your employees. And there's no formal election that's required with it. You just start deferring, but you do have to keep track of those amounts of deferrals that you did, because they are eventually due. Like Bob said, it is just a deferral. It is not a forgiveness of the tax or a credit against the tax. You still have to pay the Social Security tax for the employer's side at some point. And with that, the deferral allows you to defer 50% until December 31st of 2021. So it gives you quite a bit of time to be able to pay those taxes back, with the remaining 50% being due by December 31st of 2022. So they give you quite a bit of time to pay those deferrals back.
A nice deferral cash flow. A little bit nerve-wracking to have payroll taxes deferred that long, but you know, each situation is different. So, you know, as we've talked a lot about the PPP loan, and a lot of the folks on this, a lot of the participants in this call and in this webinar have that PPP loan in their bank account right now. In fact, some of them may even be coming up on close to their 8-week period, which we're not going to go into all those today, but we've got other videos we've talked about those, but they may be getting up on that. So if they have a PPP loan, how does that work with the deferral?
Well, those that receive the PPP loan are still able to do the deferral of the employer side of the Social Security tax. They're able to defer it up to the date of the loan forgiveness. So even once you get past your 8 weeks of the PPP loan, if it takes a while for that loan forgiveness to happen, you're able to still defer the Social Security taxes until the date of forgiveness. And also anything that you've deferred up to that point is still due December 31st of 2021 or December 31st of 2022. So you don't have to worry about, okay, today my PPP loan was forgiven, now I owe all this tax. You actually still get that time period to be able to improve your cash flows, be able to handle paying those tax payments at that time.
You know, one thing that we've certainly been discussing, and I'm going to kind of defer. I'm kind of get off track just a tad here, but the PPP loan, as I mentioned, that a lot of people's 8-week period for forgiveness is running out. I just want to kind of give a quick update. Congress right now is in the process of debating a new law, a new act that would actually extend that forgiveness period. We don't know if it'll pass. We don't know what it'll look like, but there's a proposal out there for making that a 16-week deferral. There's a proposal out there for a 24-week forgiveness time period. And so therefore, that PPP loan forgiveness extension may extend. But what we're talking about in the deferral, I do want folks to recognize that when they defer the payroll taxes, the employer portion of the Social Security, they're deferring until the date that their loan is forgiven. So if your loan is not forgiven until October of 2020, even though your forgiveness period may end in the next week or two, if you don't get the actual loan forgiveness until October, maybe even November, you could defer those Social Security taxes all the way until then. If you got it deferred, if you got the loan forgiven July 1, you couldn't defer any of your employer's Social Security taxes past July 1. Is that right, Vicki?
That is correct. That is correct. The date of forgiveness is when the deferral has to stop at that point.
So it might, you know, if you are deferring your payroll taxes and taking advantage of this provision, you might want to kind of slow play that forgiveness. It'll still get forgiven. You still will get a forgiveness, but you might want to think about it. And again, this is another reason you need to talk to your tax advisor. And I'll put a little plug in for the forgiveness. We are here at JRBT going to be working on putting together forgiveness packages for our clients that they could then give directly to the bank. So we are going to be out there doing that actively for clients. So call your tax advisor, kind of get an idea of whether you want JRBT to help you prepare that forgiveness application. I apologize for getting off track on you there, Vicki, but I did want to kind of talk about that. The other thing I need to go back and start from the beginning that I forgot to tell everybody is we do have a Q&A. There is a Q&A button at the bottom of your screen. You should be able to click on that and give us a question. And in fact, we already have one, Vicki, that asks, should the deferral also apply to Medicare tax, or is it only Social Security tax? I think that's one we really need to answer if we didn't get that clear before.
Yes, it is only for the employer side of Social Security tax. So it is not for the Medicare tax, just for Social Security.
And only the employer, not the employees have, correct?
Correct. It's just the employer. So it's a 6.2% deferral.
Okay. All right. Well, let's go on to our next. My next question for you is, and it's still related to the deferral, is we have a lot of clients that are self-employed. They have a Schedule C. They don't have a lot of employees. They actually got a PPP loan based on their 2019 Schedule C. And so they are self-employed. And so when they pay that self-employment tax, they're paying it on their 1040 each year. So they're not out there, they're not filing 941s, and they're not getting quarterly reports. They're filing on their tax return. So do they get a deferral also on that Social Security tax?
Yes, self-employed individuals dealing with their estimated tax payments still can do a deferral as well. And it's subject to the same provision as the normal employers of deferring it until December 31st of 2021 and December 31st of 2022.
Excellent. Okay. Well, that's a brief overview of the deferral. There's a lot more details that, again, you need to kind of go, but there are other options available under the CARES Act, and I know you wanted to kind of hit on another topic or two on that. So let's move on to what are some of the other available options in payroll taxes in the CARES Act?
Yes, the other option is kind of the bigger option that's available, and that's done through the Section 2301, and that's the employee retention credit. So with this credit, employers are able to receive a refundable tax credit. It first offsets the employer Social Security tax, but then after that, it is a refundable credit that you can offset against your other payroll tax liability. And it's 50% of the first $10,000 of qualified wages or qualified health insurance plan expenses for each employee. So it's a $5,000 credit per employee. So it's pretty substantial. And since it's refundable, you're able to get it back, even if your payroll tax liability is not that big. So it's a nice credit to have for the employers.
So that's $5,000 per employee up to. So if you've got 10 employees, you got a significant credit there, don't you?
Correct.
Yeah.
And with this, there is some specific criteria that has to be met by the employer. So one, you have to be engaged in trade or business. It does apply to not-for-profit entities, so that's nice to have there, but it does not apply to your governmental employer. And there's specific criteria that you have to meet. So you have to meet one of two criteria. The first is you have to be fully or partially suspend your operations due to a governmental order during any calendar quarter during 2020, or you have to have a significant decline in your gross receipts during a quarter. So everything's tied to the quarters in 2020. They're not looking at a full year. They're not looking at a month. It's dealing with the various quarters that you have.
Okay. All right. So what size entity is eligible for this employee retention credit?
Any size of entity can take the employee retention credit. The big difference between it is depending on number of full-time employees you had in 2019. So with that, they're looking at the same IRS guidance that we use for the Affordable Care Act in determining full-time employees. And so that is basically 30 hours per week or 130 hours per month determining full-time employees. So they look back at 2019. If you had 100 full-time employees or less in 2019, you're able to take the employee retention credit against all wages paid to your employees, whether they're working or not. If you go over the 100 limit, at that point, you're limited to the wages that you paid them when they were not providing services, so when they were not employed. So it's whether or not you continue paying them, even though you either had a decline in gross receipts or that you were closed because of some type of governmental order at that point.
Okay, so just kind of piggybacking off what you just spoke of there, we're full-time equivalent here for the ERC, or the employer retention credit is 30 hours a week. But if you guys remember last week's video, whenever Brian Bavona and Craig Fields talked about the PPP loan forgiveness, full-time equivalent for PPP loan, that's an SBA issue, was 40 hours a week. So again, there's a lot of confusion in this. And so you just got to be very, very careful. You know what, you look at each of the details, because the rules for this are completely different than the rules for PPP loan forgiveness. And so just be very careful. Again, one more reason you might want to consider calling JRBT to have them help you. I know in the payroll department, you guys are going to be helping with some of these credits for your clients, but call that tax advisor and see, what do I need here? And make sure that you're getting the right numbers on the right credit or the right forgiveness or whatever like that. So what time periods are we talking about for this ERC? Oh, wait, before I talk about the time period, we need to talk about who's a related employer, because we talked about qualified wages and you talked about what an eligible entity is. But we do have to remember that an eligible entity may not be just one company. So they've come out and basically talked about aggregating employers. And so therefore, if you are an individual and you own multiple businesses, so you have 75% of the ownership of company A and 60% of the ownership of company B, for the employee retention credit, those are two entities are going to be considered combined. They are going to be one entity. You don't get the opportunity to say, okay, I've got this one over here and it's going to qualify for the ERC, and then I have this company over here and it doesn't qualify for the ERC for whatever reason. If you own more than 50% of the voting stock or the control of any of that company, then be very careful. You may not be able to separate those. And what would that mean? What would be the downside of that? What the downside of that would be is you are treated as a single employer, and therefore it's either all or nothing. So if you have two companies, and I just said company A and company B, company A would qualify for the employee retention credit, but company B would not, either because of different reasons, one of which might be gross receipts. Maybe you had a huge reduction in gross receipts in company A, but you didn't have a reduction at all in company B because of in this time period. You have to combine those together and see the 50% rule that Vicki talked about. Does that qualify for both companies? And so you shove them together as one employer. So that really is a significant issue. If you've got multiple entities that you own, you need to be getting with your tax advisor, because you got to determine, do I have multiple entities, or do I, for this purpose, have a single entity? So with that being said, you may want to elaborate on that part also, Vicki. But we talked about what are the size of the entity, but what are the time periods for these qualified wages?
For the wages for this, of course, every single part of these acts, every different act has a different a different time frame. So for this one, it starts for wages paid after March 12th and before January 1st of 2021. So from March 13th through December 31st. So you're looking at part of first quarter, all of second quarter, third quarter, and fourth quarter of this year when you're looking at that criteria. So it has a totally different time frame. And even with your governmental orders, you may even have a time period that's less than a quarter if some of those orders were lifted kind of mid-quarter. So there's lots of different factors that go into this employee retention credit to know which qualified wages, which time frame that you're under. But the blanket time frame, it's March 13th through December 31st of this year. And I wanted to add one more thing in regards to your related entity as far as the employer size. So with that 100 count of employees, if you have one entity that has 50 employees and the other one that has 75, individually they're under the 100. But when you add them together, they're over the 100 at that point. So you have to make sure that you take all of that into consideration when you have those related entities as well.
And there's a lot of things the rules on these, it's amazing. They could have even thought of all these rules in this short period of time, but they sure have. In fact, I don't think we really talked about it, but where a lot of these answers that we're giving you are coming from the FAQs from IRS. And what's interesting is you have a huge list of FAQs related to the PPP loans. You have a huge list of FAQs related to the EIDL SBA loans. And now you've got, 90 something FAQs that IRS has given out on the employee retention credit, and I'm sure there's probably a similar number for the FFCRA FAQs. And so every one of these has lots and lots of information that's really hard to digest. And so that's a good point. You got to really look at the details in each one of these. So that time period is March 12th of 2020 to January 1st of 2021. And remember, the deferral was just from March until the time you're forgiven. So that's kind of a very different answer as to those two time periods, right?
Right. Correct. Yeah, if you took the PPP loan, you only have it until your forgiveness date. If you didn't take the PPP loan, the Social Security deferral is from March 27th. So you have the employee retention credit, which is March 13th, then you have March 27th, and your ending date will just vary depending on your PPP loan, whether or not you took it with the Social Security tax deferral. The employee retention credit is December 31st. So we have lots of dates to consider, just depending on which part of the act you're doing.
Okay. So let's kind of go back to the retention credit, and let's start with the employers with fully or partially suspended operations of business. And so we're going to kind of talk to you folks out there where your business was fully or partially suspended because of a governmental order. It doesn't necessarily have to be COVID-19, but obviously in this time period, it pretty much is COVID-19, governmental order of fully requiring to shut down. And so which employers would potentially qualify on this area?
So with the employers, it could be for businesses that were essential businesses that were allowed to stay open, and then also for non-essential businesses as well. But you also have to make sure your governmental order is one that qualifies. So some of the broadcasts where some people have gone on the news and stated things, if it wasn't an official governmental order, then it may not qualify through your business. So you have to talk to your legal counsel a little bit in regards to those governmental orders to make sure that you do qualify under that reason. And employers that voluntarily close their operations or close part of their operations may not be eligible because they voluntarily closed at that point. So they may have to look at the other part of the credit dealing with the decline in gross receipts to see whether or not they qualify for the employee retention credit. So it's just looking to make sure that governmental order satisfies this criteria in your area that you were affected by.
Good. Well, and so, once we're qualified, we talked about the fact that we have the 50% or the decrease in gross receipts qualification. And what I wanted to kind of do real quick is kind of tell you a little bit about gross receipts, because that's a good question. What is gross receipts? One of the things that in the FAQs it talks about is that gross receipts are the actual gross receipts of gross sales of the items that so either items sold or services rendered. So the actual gross revenue that you receive for selling your product. It is not reduced by the cost of goods sold. It's not reduced by wages. It's not reduced by anything. It's the actual gross receipts. But that also includes all the gross receipts from any other revenue sources. For example, interest, dividends, royalties. So if your business is still continuing to receive those would be included in that gross receipts test. And so generally, just be careful on that gross receipts of whether you meet the qualifications for that. And so the other part of this is, so we do have to have that significant decline. But that significant decline, you're not required to prove that it's related to COVID-19. Now, obviously, if you're closed because the governmental order said you have to close because of COVID-19, it probably is. But there is no requirement that says that significant decline has to be because of COVID-19. It just has to be a significant decline. Is that kind of consistent with what you understand, Vicki?
Yes. So, you may just have a decline in receipts because you just don't have the traffic anymore. People are not coming out, and it's not due to any type of governmental order on your business at that point. And with these gross receipts, the way that they calculate it is on a quarter by quarter basis. So they are looking at your 2019 gross receipts that you had by quarter and comparing it to 2020. So they're going to compare first quarter of 19 to first quarter of 2020 and each quarter going forward. And once you reach less than 50% of your gross receipts, that's the quarter that you can start qualifying for the employee retention credit. and you continue to qualify for it until the quarter after you reach 80% of your prior year gross receipts. So you could qualify in first quarter, qualify in second quarter, go over 80% third quarter, you still qualify then, and then fourth quarter, you would no longer qualify for the employee retention credit. So it is a quarter by quarter basis. So you have to evaluate each time to see whether or not you can take this employee retention credit every single quarter.
A lot of that's again just a little bit more to burden our small business taxpayers with, but it's a significant number and it could be well worth your deal. I wanted to skip over a little bit quickly to basically how do we claim that employee credit, Vicki? I wanted to kind of let's get on to how do we actually claim this employee retention credit?
Well, this employee retention credit just adds another thing that we deal with in payroll when it comes to reporting. We'll talk about the new 941 later on. But with this employee retention credit, they're trying to give you an immediate relief as an employer. So they're offsetting it against your payroll taxes that are due. Same thing that we were doing with the FFCRA, if you watch that video that we had previously. So if you have, say, a $7,000 tax deposit, payroll tax deposit that's due next week, and you pay $8,000 of qualified employee retention credit wages, and 50% of that $8,000 is a $4,000 credit for the ERC. You could take that $7,000 payroll tax deposit and reduce it by that $4,000 credit, and you only have to deposit $3,000 at that point. So you get immediate relief for this employee retention credit. Now, if your ERC credit ends up being more than your payroll tax liability, you have two choices at that point. You can either file the new form 7200 that we have for all of these payroll credits to request that in advance. Currently, those have to be faxed to IRS before they issue the credits. Or you can wait until you file your quarterly 941 at the end of the quarter and receive that refundable credit. So they're trying to make it where you get that immediate cash flow relief for paying these wages to your employees to keep those employees employed.
Good. Okay. Well, that's again, like I said, as you said at the beginning, that's just one more thing that we have that makes it more complex. And I know you guys at Payroll Systems are ready to do that, or getting ready to do it anyway.
Yes.
Learning how to do it. So we're here for you, and we want to help you guys retain as much cash as possible. So the other thing I want to kind of talk about, again, PPP loans, the biggest news out there, and some folks are just learning about this employee retention credit. How does that work with the PPP loan and other relief items? So how does this retention credit work with them?
So with the PPP loan, unfortunately, if you took that loan, if you applied for it and you qualified and received it, you are not eligible for the employee retention credit. There is a few exceptions of if you received the PPP loan and you were required to pay it back, where you shouldn't have necessarily taken it in the first place. If you did that, you could potentially qualify for the employee retention credit, but you're not able to do both of them at the same time. In regards to the related entities, if one of the related entities took the PPP loan, at that point, it can disqualify all of the other related entities from using the employee retention credit. In regards to the other relief that we have, you are able to use the employee retention credit along with the employer's deferral of the Social Security tax. You can do both of those, as well as with the FFCRA wages that are paid. You're able to do the employee retention credit. You just have to make sure that you don't include those paid leave wages or expanded FMLA wages for both of them. You can only use it one time. So under the FFCRA credit, you would receive it there, but not for the employee retention credit. So the big key is if you receive that PPP loan, the employee retention credit is not for you. However, we do have a lot of people who did not receive the PPP loan. So the employee retention credit may be the way that they've received some relief amid all of everything that's going on right now.
Well, good. Well, that's like I said, there's a lot in that. And what I'd like to do as a tax professional, kind of talk about from the tax side, one thing, and this is really not just tax, this is all of these items, the documentation that you're going to have to retain. You need to make sure you create these files, put them in a safe place, and keep them. In fact, Right now you really need to keep these for indefinitely. We'll eventually figure out how and when we can dispose of them. But right now, they need to be kept for a long time. In fact, I think 6 years is what we're saying for right now. But hold tight on that. Who knows how long we really need to keep these records. The other thing I want to kind of talk about is the fact that when we do get this if we do qualify for the employee retention credit, when we file our tax return in the year that you claim the credit, so when you file your 2020 tax return, you will have to reduce your expenses by the amount of the credit that you receive. So therefore, if you get a $4,000 credit, retention credit, that the wages that were related to that, you do not get to deduct the wages and take a credit both. So definitely look at that and understand that's going to affect your income tax return. But we always want a credit more than we want a deduction. So we'd rather take the credit if we can and lose the deduction than get a deduction and lose the credit. So definitely you want to take the credit. If you're qualified and you're eligible, you'd rather have the credit than the deduction, but it is going to affect your deduction on your tax return next year. And now the credit is not income, but the deductions related to that are not deductible. So, and stay tuned. Who knows what that could change. Congress has got all kinds of things out there, but that could change. So I want to change gears a little bit and now talk about the most fun topic in the whole world. That's the Form 941. Everybody loves their 941 every quarter. Everybody loves filling it out. They look forward to it. Every 3 months, they get to fill out that 941. And so it's usually actually been a fairly, it's not been a terrible form. But now, Vicki, you may not have such good news for us on that 941 front, do you?
No. Unfortunately, IRS has released the draft version. We don't have the final version yet, but they have substantially changed the form starting with the second quarter. So starting in July, all the forms that we're filing have basically doubled in size. Previously, it was about 18 lines on the form, and they have added 18 more lines to deal with all of the new relief that was released through these various acts that now flow through the payroll system. So what used to be a pretty simple form for the most part, we've been filing pretty much the same form for many, many years with just a few minor little adjustments. So this coming quarter, especially if you are taking advantage of these various acts, it will be a more complex form. We're ready for it here at Payroll Systems because we've been tracking all of these wages and credits for our clients. But if you are handling your own payroll, or even if you have another third party that's handling it, it will be a more complex form than it was before. In addition, they have separated into non-refundable credits and refundable credits. So they've created this nice new worksheet, which I'll show you here in a few minutes, that requires way more calculations than we've ever had to do on the 941 just to report this information. And record keeping, like Bob said, dealing for the annual tax return, as well for these 941s, we have to keep track of way more information in payroll than we ever have in regards to wages. So we have to keep track of the qualified paid sick leave under the FFCRA, the associated health insurance cost with that, as well as your qualified expanded FMLA health insurance costs with that, the employee retention credit, qualified wages, those health insurance, and the list just goes on, as well as any advances that you took on the Form 7200. So there's a lot of record keeping that's needed on a quarterly basis now to be able to complete this Form 941. So I'm going to do a screen share and kind of show you what it looks like in case you haven't seen it yet. One moment, let me pull it up. So this is our nice new 941 that we have. And this middle section here, where the 5A through 5D, we now have a few new lines, mainly dealing with the FFCRA, as well as now down at the bottom, well, we have all of the non-refundable portions of the credit. So we have line 11 got split into multiple lines for us. And if I scroll down to the next page, now we have on line 13B, the deferral of the employee share of Social Security tax, as well as refundable portions. They've just made this form more complex compared to what we had before. So instead of only being a 2-page form, we are now up to 3 pages of a form. And I'm not going to touch on every single line because we could definitely have a whole hour webinar just on the brand new 941. But on the 3rd page, is important. And this is something that will also help with the annual tax return as well. And that is reporting those qualified health plan expenses that are associated with all of the various wages and credits that we took. And so those items where Bob said we need to make sure that we know the qualified wages as well as the qualified health plan expenses. Whenever you're talking about these expenses that are no longer deductible, we can now gather some of that information from our quarterly 941s. So I'm going to show you now what the new worksheet looks like, which I am not going to go through it all. I'll make it a little bit bigger.
Thank you.
For you, sorry.
A lot of lines there, Vicki.
There are a lot of lines, and it all depends on whether or not you are doing the paid sick leave or if you're doing the employee retention credit, if you're doing both of them. So if you're taking advantage of all of the credits available to you, you may be completing this entire worksheet. So it's a lot of this line totals to this line. So the 941 is definitely more complex. So like I said, at Payroll Systems, we're ready for it. We've been keeping track of these wages and credits for our clients. But if you're handling your own payroll, please make sure to set aside enough time to go over this form. Don't wait until July 31st to do your second quarter, because it's definitely going to take more time than it did before. And it is a draft form, so IRS has not released the final, so there may be even more changes before they release it, but they definitely will have to release it during the month of June, just so that we're ready to go by July 1st with this new form.
Tell you what, wonder if there may be some folks out there handling their own payroll, maybe having second thoughts. Maybe they may want to give you a call at some point and see if they could get some help in these, because I would agree that the complexity, that 941 you've been filing really for a decade or two, that hasn't really changed. I mean, the lines are pretty much the same for a long time, and now there is a lot more information that you've got to be able to retain, assess, analyze, and report on that form. And so, again, we've said it, I think we've already said it about 10 times, but you got to be diligent in this. You can't just slap it together anymore. Also, I don't think you'd want to just trust an online software. So if you're using an online payroll that you don't have any human beings involved with, just trusting that, I might get some time to really make sure that 941 looks like what it ought to look like, and which means you're going to have to take some time and effort to read the lines now, whereas before you could just assume they did it right because it was the same it has been for a decade or two.
Yeah, the biggest thing is if you're doing your own payroll, and especially if you're using a computerized payroll system, just to make sure that you're using the right pay codes. Because if you've been paying FFCR wages, or if you're taking advantage of this employee retention credit, you need to make sure that you're using the right pay items, the right credit items in your system, so that way it flows into that 941. Because all the payroll systems have been reprogramming their systems this year to deal with all of the various acts that have been passed. So if you do need help with it, even if you're not a payroll systems client, please reach out to your tax contact at JRBT. I would be more than happy to help you look over it. If you have questions about your 941, because even though I'm director over payroll systems, I definitely help out with the other tax clients if they have payroll questions or need some assistance with their payroll tax reporting as well.
We even do have a number of clients who do their own payroll every week or every 2 weeks. So they process their own payroll, but we come behind them and prepare those 941s on a quarterly basis and make sure those are properly filled out before. And that might be something somebody might be interested in also. They could certainly reach out to us and see if we might be able to help them on the quarterly reports now, where before they could handle it, but now, we just need to make sure those are right and make sure that we get the right credits, because obviously we also want to make sure we don't pay too much. If we can get these credits and we are trying to take advantage of them, make sure that we get the right numbers in there. So is there anything else that's kind of what else is reported on that new draft 941 that you wanted to talk about, or you kind of already hit on all those different items so far?
Yes, that just mainly that almost every single act that has been passed is impacting that new 941. So just to reiterate that good record keeping to keep track of it. This 941 will definitely help out the tax department at tax time with regards to these wages and credits taken. So these 941s are important. Before, we were reporting quarterly, a pretty simple form that we are handling every quarter, but it is definitely more complex for this year. And pending any new legislation, we may have a new 941 for third quarter. We don't know kind of what's coming in the pipeline as far as if it's going to affect payroll taxes for the rest of the year. So we may have another version, just a few quarters from now as well. But we'll keep up to date on it and keep passing information along.
I would piggyback off what you talked about. It'll help tax. I would tell you that in the past, we've generally been able to say, if we just have the W-3s and the W-2s and the W-3 from you, we really don't need the 941. We can pretty much, for the income tax return, we can just use those forms, and it'd probably be good enough with what's in your payroll and your general ledger. But now I would anticipate for your 2020 tax return, we will need all 4 quarters of those 941s, the entire form. And so make sure you're keeping that in a good, safe place so that we can, we'll be able to get that when we prepare your tax return for 2020, because there is a lot of information that we will have to have related to PPP loans, related to other credits, how we take your deductions, how we limit deductions, how we do all those kind of things. And so it's, we've scratched the surface of the CARES Act payroll tax credits. We've talked about today the employee retention credit, the deferral of employer Social Security taxes, talked about the 941. There certainly is a lot more. As I mentioned in the middle of this webcast, Congress, I believe right now, is talking about another bill which could make all this moot. They could change every bit of it, and we could have to do this all over again, Vicki, which I know everybody would love to see us come back on and be on video for another 45 minutes explaining the really exciting subject of payroll and payroll taxes. But hopefully this has been helpful for you. Hopefully this has been something that's really given you a little bit of insight into maybe some of the things you can do for your business to retain a little more cash during this really tough time. And so the only other thing I'd say is I do have a lot of questions here. We're already at about 45 minutes, and we kind of allotted about 45 minutes. What we'd like to do with those questions, if we got a number of them answered, Vicki, in the broadcast. There are a few that are left out there. What I'd like to do is tell you, if you had a question, we will, Vicki or I or someone else in the JRBT team will get back with you on your specific question. Don't hesitate to continue to ask those questions. Also, don't hesitate to email your tax professional with those questions. There's a lot of communication that needs to be happening right now between your CPA and you and your business. So, because there's so many things happening so fast. Yesterday's answers may not be today's answers. I guess, is there anything else you wanted to kind of follow up with or wrap up with, Vicki?
No, just don't hesitate to reach out to us. Reach out to the tax advisor. If you're one of our payroll clients and you have questions about some of these credits, please do not hesitate to reach out to me. If you contact one of our payroll specialists, they'll get with me as well, so we can make sure that you're taken care of and help point you in the right direction with these credits as well.
Well, I wanted to remind everyone that this video has been recorded, and it will be on our JRBT website, as I mentioned before, www.jrbt.com. All of our videos are out there, along with our Facebook. This has been live on Facebook, and so it will be recorded and it will be on there on our Facebook page. In addition to YouTube, we have a JRBT YouTube page. We'd love for you to go look at it there, and LinkedIn. So we have a lot of ways you can come watch these videos. Luckily, Vicki's on the video more than I am, so that's probably a positive for everybody. But with that, I guess this is going to conclude this version of the JRBT Tax Talks. We have a lot more to discuss with you. We've got a lot of topics and a lot of folks that are ready to come get you a lot of information. So, Vicki, thank you for your time today, and for everyone out there, we truly appreciate it. We know that payroll taxes is a big part of your life and a big part of your business, and we need to make sure we get those right. Hopefully you've learned some information today, and we look forward to seeing you on the next edition of JRBT Tax Talks. Thank you, everyone. Bye-bye.